The way this works, there's a 10-minute block for the students. I'll be keeping time. I'll give them a warning at about a minute to go. After that, you get up to another 10 minutes where you can pepper them with whatever questions come to mind. If there are any students that are still in the room, I'm afraid you're not able to watch other teams, but faculty advisors, industry mentors, anyone else, you are welcome to stay. I think that's pretty much it.
There was a random, by the way, selecting which
Yes.
team goes first. Okay.
Yeah.
Part of everybody's strategy.
So these weeks, you want to think by number or by the name of the number? This is team number one.
Okay.
Number one, right?
Okay. Good start for time. All right. Good afternoon, ladies and gentlemen. First off, we'd like to thank CFA LA for hosting us today. We'd also like to thank our title sponsors, FactSet and Kaplan. I'll go ahead and introduce our team members. My name is Nate Fisher. This is Aaron Averill, Aaron Hayes, Vivian Wallen, and Robert Ritchie. Now, I'd like to start our presentation today off with a question. What is Disney? We are here to convince you today that Disney may not be what you guys think. They are not just the rampant producer of your children's toys or your local Disney experience. In fact, they are a media powerhouse and the company to own in the media space. So now, what is media? We think Bob Iger said it best. When you think about it, media is the intersection between content and technology. It's all about storytelling, the intersection between the story and the gadget. Now, we think there's a lot of companies that focus on content and a lot of companies that focus on technology, but we believe Disney does both equally. Disney has an incredible ability to innovate new content and intellectual property and disperse and leverage this across their 5 business segments. They also hold a portfolio of great brands, such as Pixar, Marvel, Star Wars, and ESPN, just to name a few. Furthermore, we issue a strong buy recommendation with a target price of $105.46, which reflects a 16% upside. We found key drivers for Disney to be Star Wars, the opening of the Shanghai park, and continued success of ESPN. Strengths to Disney include their unique spillover effect and their aptitude in M&A. I'm now going to pass it off to Erin, who's going to cover Disney's dominance across their various industries.
Thanks, Nate. Disney is a powerhouse thanks to its 5 business segments: media networks, parks and resorts, studio entertainment, consumer products, and interactive. The company competes in a number of industries, under what we like to call an umbrella of leisure, since revenues are heavily influenced by how consumers choose to spend their free time. The primary industries Disney operates in are the media and entertainment, travel and tourism, and retail industries. Disney and its top competitors must constantly evolve to changing trends and consumer preferences. What is it that differentiates Disney within these highly competitive industries? Disney's key strengths include its diversified sources of revenue, its brand strength across its segments, its ability to compete globally through localization, and its excellence in acquisitions. These strengths work together to make Disney a leader in content, technology, and distribution, giving it a competitive edge that is unmatched by any of its rivals. A highlight of the media networks business is ESPN, which is currently the most demanded network on television. The Parks and Resorts segment will capitalize on China's rapidly growing middle class with the opening of Disney Shanghai in 2016. We see the studio entertainment business is the segment with the most potential for growth, with 21 films slated to release over the next 3 years. The consumer products and interactive segments will be successful thanks to the spillover effect from Disney's impressive pipeline of movies throughout 2017. Putting a price on a company as large and complex as Disney is a challenge. To help you understand how we did this, I'll pass off to Aaron, who will discuss our valuation methods.
Thanks, Aaron. Now moving on to valuation, we actually used 4 different models, weighted each model, and used Monte Carlo simulation to account for uncertainty and risk. Our price target of $105, 16% above the price on January 31st, which is 60% higher than our benchmark, represented by the S&P 500, at which we estimate 10% target return in the coming year, which we believe is evidence for our strong buy recommendation on Walt Disney Company. Our sole relative model is a comps model. We looked at comparable firms in Disney's studio, media, parks and resorts, and consumer product segments. Above, you can see the metrics, the multiplier value, and the weight that we used to arrive at our relative prices. The dividend discount model was coupled with our discounted cash flow models for our intrinsic valuation. As the Rule 72 helps depict, it is unrealistic for Disney to continue to increase their dividend for many years at the 34% that we saw earlier this year. That is why we set conservative ranges for our random growth sampling for each of our stages and our terminal stage. An unlevered discounted cash flow model received the highest weight at 50% and a price target of $108. Our cost of equity was calculated using Farmer French's three-factor model. We did account for a change in risk-free rate. Sales forecast was done using 3 different techniques, and we used these results as a guide for our analyst base case. Each of our models was weighted based off our confidence in our assumptions and suitability to Disney, and to arrive at our price target of $105. The above distribution backs the following two statements. As of January 31st, we were more than 90% confident that Disney was undervalued. And we were more than 50% confident that Disney will outperform our benchmark, spoken of earlier, at 10%. Now I'd like to pass it on to Vivian to talk more about Disney's financials as well as our investment summary.
Thank you, Aaron. The Walt Disney Company has seen exceptional growth over the last decade. And with the path that Bob Iger has set, we believe that this trend will continue for at least the next several years. So in order to create the thorough and complex valuation models discussed, we first had to evaluate the company's macroeconomic factors, historical performance, and changing demographics in order to see how the company would perceive uncertain changing dynamics in the future. We believe that long-term sustainable growth will be achievable through its continuing trend in international expansion, as you can see right here. Now moving on to investment summary. Since its inception in 1923, the Walt Disney Company has built incomparable growth in North America, incomparable brand equity. In those grown into a large multinational conglomerate since then, we still believe that it has simple and powerful core competencies which allow it to further gain market share, both domestically and internationally. First, they are the leader in creating original content and distinguish it from its competitors. Secondly, its proven history of merger and acquisition competency has allowed the company to construct a large wealth of intellectual property in which it capitalizes on in numerous ways and across a broad product breadth line through the halo effect. Third, this was a company has created and mastered a waterfall process for all of its successful content distributed across all of its segments and be efficiently and effectively utilized at the forefront of technological and creative innovation. It is these competencies that has allowed the Walt Disney Company to be successful in the past and why we believe management will do a great job in the future. It is key projects, strong management, and numerous other factors that we believe the Walt Disney Company will significantly outperform the market. We do not view the Walt Disney Company as a short-term trade, but a long-term investment that will provide increasing return on equity year over year for investors. Now I'm going to pass on to Rob to go over associated risks to the company.
Thank you, David, for talking to us about our investment summary. I will now talk about Disney's major risks. We have analyzed Disney's major risks by impact and probability, and also analyzed how they mitigate these factors. First, changes in consumer preferences. Changes in consumer preferences affect Disney across all their business. Mitigation factors include Disney's high investment in research and technology. Second, expiration of long-term programming or carriage contracts. Due to Disney's involvement in the media space, they're inherently involved in long-term contracts. This creates 3 major challenges. First, loss of programming. Second, higher rates. And third, secured costs but unsecured revenues. And finally, increased competitive pressure. Increased competitive pressure affects Disney across all businesses, and increased competitive pressure affects Disney across acquisitions and cost pricing for their products and services. Mitigation factors include Disney's high levels of cash, their dominant market share, and their historical ability to innovate not only to maintain, but build market share. In summation, Disney stands alone in the media space due to their high-quality name brands, great pipeline of content, and unique ability to leverage their creative success and create value across their businesses. Moreover, we see these key characteristics as reasons why the Walt Disney Company has a veritable moat around their business, and as key reasons why, for our $105 year target price and strong buy rating. Thank you for your attention, and I will now turn it over to questions.
You estimated earlier that you actually showed the revenues for each of the divisions. media was the largest of those four.
Can we go back to that slide? Do you mind?
The media slide?
I had a question on that too.
Yeah.
The one where you show the breakout by revenue.
Sure.
That's actually
Financial
the
analysis. Rob.
It's at the very beginning.
Okay, yeah. Those are contributions to revenue, but with growth and all that stuff factored in, I mean, I would think that some of those segments are more valuable than they appear in terms of revenue, which, like, how much do you estimate the value of Disney is, what percentage of the value of Disney is their media network?
Rob, do you want to go ahead and answer that?
Yes, so Media Network is a key strength for Disney. So we may view it a little bit stronger than our 43%. However, there are other key factors like content is, due to the halo effect, content really starts and begins in studio entertainment. So if you're looking at it that way, studio entertainment has more value in regards to the halo effect due to the fact that when content is created in studio, it is then leveraged throughout the company from there.
So second on top of that, yes, media is one of their strongest segments. With ESPN contributes a large chunk to their earnings, but Disney receives a premium on the market due to growth in some of these other segments, as we mentioned previously, parks and resorts, and the other growth prospects.
Do you have, I want to follow up on Roger's question there. Do you have anything similar to this that would give, for example, earnings as opposed to just revenue, or growth estimates for these 5 segments here?
Sure.
Yeah.
I'll take it. Sure.
Even if you don't have a thing,
Yeah.
you guys kind of walk through that.
Sure.
For us trying to come up with this growth and
Yeah.
contributions.
Yeah, thank you for your question. This actually gives me an opportunity to talk a little bit more. I mentioned that we use 3 sales forecasts done primarily with regression analysis. So we looked at multivariate regression analysis, so geographic as well as real GDP, looked at correlations there, forecasted using that. We also used an auto regression, and we looked at those results. But we really wanted to be able to account things that we know, like a very promising pipeline, Disney Shanghai, into our projections. So that's where our analyst touch came in, rather than relying solely on the numbers, but we did look at them.
Add on that, we see the most growth coming in studio entertainment. While even though media is the largest, we see company growing and diversifying more. Well, it'll be less risky and more evenly diversified in terms of sources of revenue.
And studio entertainment is the movie business?
The movie business, correct.
What's the impact of lower oil prices on the parks and resorts?
Yeah, absolutely. With the recent drop in oil prices, tourism has increased a lot, but the main effect in terms of the parks and resorts segment doing so well right now is, we believe, is the currency exchange rate. High currency exchange rates influences more international travelers coming to the U.S. and encourages more domestic travel as well. So the parks and resorts segment has done incredibly well over the last couple of years. It does take a big hit during economic recessions, but the company does a great job at keeping the division healthy and relevant to youth.
One other point on macroeconomic impacts on the company. You mentioned oil prices, but also FX rates is a huge thing right now with the strengthening dollar. Based off the company's last earnings call, they did mention that maybe you would expect to see less people traveling and going to domestic parks because of the strengthening dollar, but they haven't seen that yet. But we do feel like the strength in these franchises will overpower that.
So looking at the revenue distribution here, what percentage of it would you say is domestic and what percentage is international? And how do you think that's going to impact your valuation?
Yeah, I'll take that question. So, like we said earlier, the Walt Disney Company has been doing a great job of expanding, especially internationally. So in the year 2000, international revenues were about 13% of the total revenues. In fiscal year 2014, they were 25%. With ongoing projects like Disney Shanghai and other partnerships in China, other countries, expansion in Europe, we believe that this number is going to increase even more.
To add on to what Vivian said, CEO Bob Iger has 3 pillars for his management strategy, and one of those is to expand internationally. So if we're looking across the time horizon, we would expect to see greater volume overseas.
Sure.
So specifically, how much do you think Disney Shanghai will contribute to the bottom line, and is Disney Hong Kong a good model for that?
I'll go take that question. So the Walt Disney Company is kind of very secretive and low-key in terms of not releasing any projections or expectations. However, it has the most potential out of any parks. They have 330 million income qualified people within a 3-hour travel radius of the park. There are 30 million new entrants into the middle class in China every year. So the emerging middle market is who they're targeting, and we believe that it will be, well, the first 5 years, it's going to be hard for them to turn a profit just because of the high capital expenditures, but they've seen that with every park. We believe that this park will essentially be the most profitable and the most successful park that they have within the next 7 years.
So the Chinese like Disney.
Yeah,
they're-
actually, to add on with that, Disney actually just extended their partnership with Shanghai Media Group. They used to just collaborate with them to distribute movies in China, but they've been doing so well that they actually extended the partnership to involve television programs now. So China likes Disney.
Yeah, and if you guys have followed Disney in the past, you know that the Disney in Paris was a failure at first because they didn't adapt to the culture there. With recent management, they've learned how to adapt to the culture there. They've learned from the failures in Paris. So in Hong Kong, in Tokyo, and now in Shanghai, doing a great job at adapting to the culture, partnering with local companies to make sure that their content is relevant to the demographics.
Do you think poor IP protection in China is a problem for Disney?
Not necessarily, because they are headquartered out of the United States. The only business they're really doing there is the parks and resorts, and then they're partnering with certain studio groups in China, which I think Aaron can talk about a little bit.
Oh yeah, well the partnership with Shanghai Media Group, they distribute films and Disney content to television channels and other outlets in China, and this is connected with the Chinese government, so that adds an extra level of security to it. So I don't really think we see a problem with IP protection in China.
Yeah, so the Shanghai Disney project is 57% owned by a joint venture of 3 Chinese government bureaus and 43% owned by the Walt Disney.
Last thing to touch on the question you were mentioning, the risk of IP protection in China. One thing that we would mention is, I believe it's about a quarter of their revenues are overseas. So we expect Disney Shanghai to revitalize that growth, spearhead that growth. But they did mention in 2014 that their Disney's Magic Quest is increasing in efficiencies in their parks, which actually canceled out the expenditures that they saw in Disney Shanghai, as well as they delayed their release of the park, which we actually see as a positive. They're really being careful with their entry into China, which is a country that you really need to consider the government and think about that and really make sure you have all your bases covered.
Can we go to your valuation model work that you did there? You've got a number of different models that you kind of
Sure.
summed up, right?
Yeah.
Did you do this at the company level, or did you try to do this at each individual segment level and then sum up across the segments?
Sure. If you could actually go to the unlevered DCF. So we did, our sales forecast was by segment. We looked at historical, we calculated standard deviations there. And like I said, we tried a couple different techniques, but we eventually our fallback was on our research and where we think we're going to see bumps. But we did account for uncertainty and risk with our Monte Carlo simulation in our sales forecast based off historical standard deviations.
Of each segment?
Of each segment.
Of the
Yeah.
segments,
Mhm.
okay.
But then forecasted by segment, but then we just tied that to total Walt Disney revenue by adding up each of the segments.
Absolutely. It was essential to do it by segment here because each segment kind of operates in some other industry, but they have their own.
Great work.
How, you done?
Oh,
How important is management to the overall success of Walt Disney?
Yeah, we think management's critical to the success of Disney. If you look at the past, say, 3 to 4 years, maybe even go out to 6 years timeline, under Bob Iger, they've acquired Lucasfilms, Marvel, very successful brands with strong intellectual property, which fits into Disney's business model and how they use their synergies and distribute the content throughout their 5 business segments. And I'm sure you've seen in the recent news that there's speculation about who would take the throne for Bob Iger, and we're confident that going forward, Disney has a deep bench of management talent, and we're confident that they'd be able to continue the success that they've experienced recently.
And I'm sorry to come back to this. All right, so you talked about unlevered discounted cash flow. Did you do the same thing for the levered discounted?
we also
cash
did
flow?
levered. So unlevered received 50%. It's valuing the enterprise value of Disney. But we gave 20% value to our levered.
Same approach.
Same approach. Yeah, same assumptions on sales forecast.
Okay.
Thank you.
Thanks so much.
Appreciate it.